what is an alternative lender, right? So I mean, help break that down for us, Ryan. What would you consider an alternative-based business lender?
I would consider alternative financing something that's quick, easy to access, and is revenue based.
Yep.
That's what I would clarify as alternative financing. Whereas traditional financing, they're going to be more looking at the profitability of the business. They're going to be looking further into credit. They're going to be looking into your time in business a little bit further. That's some of the biggest things I would say is the difference between alternative and traditional.
100%. And really,
Anywhere from $80,000 to $90,000 on a monthly basis. So getting her $40,000 wasn't an issue, but being able to settle out and keep that from going to legal and making things a hell of a lot more expensive for the client was worth it in the long run. So she wasn't concerned about the interest that she was going to pay to get access to quicker capital.
Right.
And that's the thing. She needed it sooner rather than later. She had a good use for it, and she's going to take it. And she's going to continue to be For sure. So some of the biggest things the lenders are going to look at is cash flow. Cash flow is going to be a huge thing that they're going to want to see because they're going to want to be able to make sure that you can sustain your payment. Right. So they're going to see how our daily balances are looking, if we have any overdrafts or negative things, debt to income. So any current loans that you have that are being pulled out from the bank statement is going to count towards what the lenders can afford to give you.
Right.
They're going to look to see where your revenue is coming from, if it's sales, if it's wire transfers, cash deposits. A huge thing in our industry is collectability.
Right.
So the lenders want to make sure that, God forbid, anything does happen, that there's a chance for them to go and collect their funding and be able to recoup their assets and their investments.
Sure.
So it's all kind of judged off a risk standpoint, and certain industries are riskier than other. And that's essentially what they're going to look at in your bank statements. As far as your higher risk industries, your construction company, your trucking company, anyone that's not really having a high volume in sales on a consistent basis is going to be a little bit more high risk than as compared to like a retail shop or a pizzeria that's dealing with hundreds of transactions on a daily basis.
Absolutely, 100%. And that's something to really importantly identify when you're approaching business financing in the alternative fashion is, do I have the upper hand or do I have the lower hand? And based on your industry, just, obviously you can't control this. I don't think that you should decide where to go into business just based on what's the best financing for you, right? So
Absolutely.
that said, you need to call a spade and identify whether or not maybe alternative financing is in your benefit or maybe it's not. And identify that when approaching, you may need to really have your ducks in a row to make sure that your credit scores align, that your balances have been strong, because otherwise options are going to be few and far between for your general construction guys that are in between deposits and have inconsistencies in revenue, right? So I think that's the biggest thing that these lenders are looking at is the consistency of the volume coming through the business's bank statements, right? Because that's what a healthy business is all about, is consistency. How consistent can this business stay on this trend? Ideally upward and to the right, but in an alternative lender's eyes, at least on pace to where they've been for the last 3 to 4 months, right? So that being said, that's what they're gauging all of their business on. So understanding the location, right, is going to be huge, because if you're a waterline business, you're going to be slow on the winter months. If you're a business that is on close to a ski resort, you're going to be better in the winter months. So that being said, it's all demographic based, and a lot goes into the consistency and determining the consistency of the business's health of that revenue.
Which brings up another good point. A lot of lenders, what they're going to want to do is they're going to want to look at what's called payback months. And essentially that's going to be the months that you're paying back your loan. So they want to see how the business performs last year and then compare it to this year, and that may affect your offers drastically. If you are looking to take out financing right now, well, last year, your November, December, January, February, and March were super slow. Revenue was down. Business isn't really generating a lot of income. Lenders aren't going to want to lend you money over, the next period of time, because they're afraid that what happened last year might be the pattern and happen this year.
Absolutely.
It's a huge thing to take into consideration that a lot of people don't even really consider before going for financing.
For sure, 100%. And whereas that differs from your traditional loan, because they want to see previous years. Some alternative lenders on X amount of funding need to see 12 months of bank statements to affirm that consistency, right? So that's what it's all about, is the consistency in the volume of the business's transactions to affirm the risk factor for the lender, really. And aside from those two major points, a second key metric is going to be the credit score, right? So it's not all about the number, right? Everyone gets fixated on what that number looks like, and I've seen credit reports that have a 700 that had repossession on there, that have been late on their credit cards, just with a ton of history and a ton of years, right? However, I've also seen 650s that are down below that threshold just because of utilization, right? So it's not the number that tells the whole story, right? So when approaching financing, of course, the better that your track record has been, the more likely that you'll get the cheapest rate possible for yourself. But at that, it's going to need to identify when you're approaching business financing, your credit cards are highly utilized, it's something to call a spade, that options are gonna be limited to you, right?
Well,
Line of credit lenders are gonna limit you based on how much revolving credit you have if your credit's really highly utilized.
correct. No, absolutely. And it's a big thing that lenders do take a look at. We have lenders that will really look in any situation, whether your credit scores at 400 or your credit scores at 800. We have lenders to really be able to fund into any credit range, but it's going to drastically affect your loans. So your higher credit score borrowers are going to qualify for things like lower terms and then maybe cheaper interest rates that'll tie into that as well. And your lower credit score borrowers, it's going to be a little bit shorter term and more expensive. It's not going to really play too much of an effect into dollar amounts since we're talking cash flow based financing.
Right.
But there is still a lot that credit can play a mitigating factor in navigating what approval is going to make sense for you guys. So it's something to consider.
Absolutely. What do you think, Ryan, is like the biggest flag that you see on a credit report that you would say it's going to be an automatic no-go, or something that you know it's going to be a difficulty to place that file?
Yeah. So any type of bankruptcy that's going to pop up on there is going to be tough. I know any type of missed mortgage payment, if that's popping up on the credit report, that's really going to be a tricky one to get around. Late on car loans can definitely affect us, not as drastic as the other two. Some small factors, things that don't really matter as much as our student loans. People aren't going to look too deep into that. Your biggest ones are going to be those expenses that should be getting paid on time, like a mortgage, something like that. If you're missing on that, it's going to be hard for a lender to justify giving you alternative financing that doesn't have any collateral.
For sure.
So it definitely, I would call that the biggest factor.
I couldn't agree more. I mean, realistically, I think if you're not paying for your home, that's the biggest red flag. That first thing, late mortgage payment, I don't know. Tough file to place. Everybody goes through a tough time, but that's the number one thing that everyone makes sure they can pay first. And when you can't pay that, you're showing a hardship. And again, call a spade, when the lender's giving you the offer about your situation,
It's going to reflect.
that's it. So that being said, moving beyond credit score to talk about just some other dynamics and specifics that they're looking at, right? Let's talk about like the industry specifically, right? So what do you feel as the alternative lenders dislike? What are some industries that are more difficult to fund?
The biggest that stand out to me are probably going to be your construction, your trucking, and your cannabis.
Right.
And I would mention those three. Cannabis, the biggest issue with it is it's not fully legal. It's every state has different laws regarding it, so it's tough to be able to justify financing something that isn't federally banned.
Sure.
Transportation is just going to be limited because of the competition in the industry as a whole. Ever since COVID, there have been trucking companies that are popping up left and right, and it's just causing their loads to go down, their rates to go down. When everybody's bidding on the same jobs, it caused a really tough market for them, right? So their profit margins are super thin, and they're not getting those daily receivables that are going to help pay, a cash flow based loan. Construction, their biggest issue that I'm seeing is really the lapse in payments from clients. So everything is going to be on net 30, net 45, net 60. Unfortunately, sometimes even net 90, net 120. And it's tough when you're having to chase down money and you're having a bill that's reoccurring either daily or weekly, and your revenue is coming in every 30, 45, 60 days. It's tough to make sure that those bills are getting paid on time. So those are the three biggest things that lenders are going to take into consideration with those specific industries that I would call very tough to fund.
Yeah.
Fundable, absolutely, but definitely harder to place.
For sure. And moving past the tougher industries, just a couple of better industries that you see up and trending to the right that are solid for alternative financing.
So one that's going to be great for alternative financing is going to be restaurants. Essentially, alternative financing started in the restaurant industry because you used to need to have a credit card machine, and they would take a percentage of your credit card sales. So any industry that is really going to be credit card sales and high volume, I would call restaurants, medical, and retail. So like your clothing stores or your knick-knack shops, anything that's doing a large transaction of sales on a day-to-day basis. And the reason lenders are like that, right, is if you miss out on, call it 10 sales that day, you have 250 more.
Sure.
If you miss out on 10 sales in the construction industry, revenue is going to be a lot lighter,
Sure.
which is the biggest difference, right? So they're looking at consistency and quantity over really large deposits.
Yeah, absolutely. Everything kind of ties back to one another, right? So that being said, the lenders are always looking at that consistency of volume and how likely it is for them to collect and how likely it is that the business stays on the trend that they've been on or up and trending to the right. So that being said, those industries are key driving factors in kind of understanding the dynamics of these businesses and the risk factors associated. One business that I specifically see, are e-commerce businesses and not fintech, but technology-based businesses, right? I have a business that I just funded recently, last couple of weeks, that was a technology-based business. They created an app that you can use AI to customize your room. You can take a picture of a magazine and then use it essentially in your room with your camera. And then it puts the two together, and it puts the design in your room, and then you can tap on the things in your room and buy them real time without having to go and search for everything. So it's a very cool company, right? So they went through a round of acquiring debt through a few different rounds through SBA, through a couple of other secured options, a couple of equity-based options. Essentially, it was like a $3 million round of debt that we helped them get $250,000 of, and they are projecting that this company is worth 9 figures over the next few years. And based off the technology that I saw, the prototype of this product, it seemed like the coolest thing that I've seen. And there's so many of these companies that are just coming out of thin air, right? And there's so much opportunity, right? So I think that the alternative financing space is perfect for these guys that are looking for the bridge fillers before they really hit that huge jump. So I think that's one industry specific that stood out for me. Moving on though real quick, another metric is just the time, right? Like how long has that business been in business, right? So that leads us back to the likelihood of the consistency of that business's revenue, right? So if a business has been there for 20 years, it's much more likely to make it the next 12 months, right? If a business has only been there for 12 months,
who knows what the next
it
12
could be a
months
50-50 shot that the business is there in the next 12 months.
for sure.
Just speaking statistically, right? So that said, it makes it a huge different risk parameter for the lender in order to determine, what can be affordable and what's affordable for them, right? So that said, lastly, last metric to really talk about is just like the risk that the business owner is assuming as a whole, the lender is assuming as a whole rather, by investing in the business, right? So is there some type of security? Is there a personal guarantee? Is there not? Is there is this a revolving loan for some of our alternative lenders, right? So that being said, help me understand, right, where lenders have these revolving lines of credit out, right? Where do you find that lenders find the most secure that business is gonna stay in business? When do you see the most line of credits get approved, and why do you see them get approved for those businesses?
So a lot of it comes down, in my personal opinion, to credit. I think credit's the biggest factor on that because it's going to show their history and their trade lines in regards to borrowing and using credit.
For sure.
They're going to see, how long they're carrying their debt out frequently, how they're making their payments on time. I would say that that's the biggest factor. And then another one really is just going to be kind of balances as a whole. They want to make sure that they're going to have the balances to be able to support a payment at any point in time, depending on how much they have utilized.
Right.
So those are the two biggest factors.
For sure. And just going over the risk factor, right? So just like the risk factor as a whole with these lenders, I feel as though they're just constantly looking at how consistent is this business going to be, right? And there's these huge companies to shoot out a couple of, I guess you could say, almost like household names at this point in alternative space, like On Deck and Headway and Rapid, right? I feel as though they find the most, success with their line of credit product with those that have a good track record of a credit.
Right.
That's the biggest thing. Just those that have had credit for X amount of years, that have had high limit revolving business credit cards, that maybe had home equity lines of credit, that have mortgages, that have extensive credit reports. These are the businesses that get approved for the more usable alternative line of credit product, absolutely, transparently. And when going to approach alternative lending or looking to, explore expanding your business over the next X amount of time, it's important to pay attention to these things now that you have, the upper hand before you need it to take action. Before you need to take action by actually expanding the business and needing money in hand, because when time's against you is when options become minimalized, and when options become minimalized, the cost goes up typically. And at that, we're always trying to avoid that at Lexington. We always want to help our borrowers get the best cost of capital possible, right? So, that being said, I mean, what are some takeaways for you in every day that you see your typical business owner running into issues from everyday operations?
Not being able to manage payroll properly. We see that a lot. It seems like people don't know how to allocate where they're going to directly put incoming revenue from jobs that they're completed, whether a certain amount needs to go to payroll or insurance. It always seems like that kind of gets lost in the mix.
Right.
One thing I do see from a lot of my better borrowers is having a separate account to be able to cover expenses, and then an account that's going to be able to handle everything that's coming in.
Right.
So this way it's very clear and put right in front of you what your business is generating and then what needs to go out. And then every month kind of do a reassurance and double check everything and see if there's a way for you to be able to keep less money going out and more money coming in.
For sure. Yeah, I think projecting cash flow terms, that's the biggest shortcoming for most businesses, is not being able to identify how much needs to come in by when to cover all of accounts payables and affirm that the receivables are there on time to cover those payables, right?
Bridging gaps is huge.
Exactly, 100%. So I mean, really actionable takeaways from this whole to do is one, to pay attention to your bank balances, right? Pay attention to keeping consistency in terms of the amount of money that's in the bank account, so lenders can deem you more fit, more able to afford a payment. The consistency is everything. Secondly, that credit score, right? You always want to try to approach financing with as little utilized at that time as possible, right? I wouldn't say to look to do a big project at home before you go and try to expand your business, right? You want to try to time these things accordingly, if possible. But when not, we still do have the placement in order to make this happen. Any other takeaways they want to have with us tonight, Ryan?
Really, just I can't reiterate enough how important it is to stay on top of your financing, to make sure that you are preparing. And if financing is something that you want to take a look into, start looking now. Whether you're looking for financing in a month, 2 months, 3 months, start getting your files in order, make sure things are starting to look properly, hold those balances a little bit higher, and definitely pay attention to that. It's going to be something that's going to set you up for success when you're looking for financing.
For sure. Awesome. Well, again, I think that's going to conclude tonight for you guys. We appreciate you guys always coming out and support. If you like the content, please feel free to like, comment, and subscribe. Again, my name is Digi.
And I'm Ryan Showe.
And we're looking forward to giving you guys a ton more content just like